Is the U.S. economy really in trouble? This question has been at the heart of the rivalry between the United States and China, one of the most crucial economic and geopolitical relationships of our time. Recently, tensions between these two global superpowers have escalated, particularly in the realm of trade and finance. With growing concerns over China's actions in the financial markets, but what's really at stake here? The situation has been unfolding for some time, but the latest development has been a sharp drop in tech stocks, particularly the Nasdaq, as investors react to fears about China's rapid advancements in artificial intelligence. This sudden market turbulence raises alarms. Could China's economic moves be shaking the U.S. to its core? On one side of the dispute is the United States, eager to maintain its dominance in global trade and finance. On the other side is China, striving for a more dominant role in world markets through increased production and exports. Both countries are wielding heavy economic tools, including tariffs, targeting each other's technology companies and making strategic diplomatic maneuvers. But the real bombshell came when news broke that China had wiped out $1 trillion from the U.S. economy, sparking widespread outcry. The U.S. has been wary of China's growing influence for years. When Donald Trump assumed the presidency, he made it clear that one of his top priorities was to reduce the U.S. trade deficit with China. His America First mantra led to tough policies, including tariffs on Chinese goods. These tariffs were meant to protect American industries, but instead led to a trade war that created ripple effects across the global economy. In response, China retaliated, intensifying the pressure on American farmers and producers and leading to disruptions in the global supply chain. However, the most damaging move from an economic standpoint was China's decision to sell off U.S. Treasury bonds. For years, China had been one of the largest buyers of U.S. debt, but now, with a less reliable buyer in the market, the value of U.S. bonds began to drop. As a result, U.S. Treasury yields have risen, making it more expensive for the U.S. to borrow money and increasing the burden of the nation's public debt. This unexpected financial shock was compounded by the actions of algorithmic trading, where AI-driven systems exacerbated the volatility of the stock market, potentially wiping out as much as $1 trillion in value in a matter of days. But is this really the end of the U.S. economy as we know it? Of course, the U.S. is still the world's largest economy, and an instant collapse is unlikely. But the sudden disappearance of such a massive amount of wealth raises serious concerns. As much as $1 trillion, an amount larger than the annual budget of many countries, can evaporate in the blink of an eye in today's hypersensitive financial markets. So, while the U.S. economy is not on the verge of collapse, the long-term implications of China's strategic moves are undeniable. China's aggressive economic policies and financial market maneuvers have left many asking whether the U.S. is truly prepared for the impact. The trade war that began under Trump's administration has not delivered the results he promised. While Trump sought to close the trade deficit and protect American workers, the tariffs imposed on China ended up hurting U.S. producers as much as they hurt Chinese companies. In the end, China has proven resilient, building its own economic networks and finding new trade partners, while the U.S. has faced greater costs and market instability. Could this $1 trillion loss be a tipping point for the U.S. economy? Analysts are concerned about the growing public debt in the U.S. and how that could be exacerbated by rising interest rates and a lack of foreign buyers for U.S. bonds. The possibility of a widening financing deficit could lead to a severe recession in the coming years, making it harder for the U.S. to meet its debt obligations. Some worry that even a country as large and influential as the U.S. could eventually face significant financial difficulties. Despite these concerns, the U.S. economy is far from giving up. It still holds significant advantages, including its leadership in technology, defense, and consumption. The dollar's status as the world's reserve currency remains a strong pillar for the U.S., and it's unlikely to be toppled by China anytime soon. But there's no denying that China's rise presents a challenge that the U.S. is struggling to manage. And these economic fluctuations may continue to undermine U.S. stability. The question of whether the U.S. economy is truly in trouble is complicated. While it remains one of the world's most powerful economies, its financial stability has been tested by both internal and external pressures. The volatility in the stock market and the growing public debt are just two signs that the U.S. economy may not be as invulnerable as once thought. China, with its massive trade surpluses and strategic economic moves, could continue to weaken the U.S.'s position in global markets. Trump's biggest miscalculation was underestimating China's resilience and its ability to navigate the global economy with greater agility. He believed that a simple trade war would force China to back down, but in reality, the situation has become far more complex. The fight is not one that can be won easily, and it requires a long-term strategy rather than quick fixes. The U.S. has found itself entangled in a battle that it may not have been fully prepared for, and as we continue to watch the developments unfold, it remains unclear whether the U.S. will regain its economic footing or if China's economic power will continue to rise unchecked. In the end, the rivalry between the U.S. and China is far from over. As tensions mount and economic policies shift, the question remains, can the U.S. recover from the blows it has sustained, or will China's growing influence be the beginning of a new world order in global finance? Asterisk.